Alrighty then. We're gonna go ahead and get started. Well, actually, let's wait a couple more minutes. Start at 11:35. See who else joins. See a couple people in the attendees that I know. Hello, Amanda. How are you today? See your attendee. Welcome. Awesome. So people are starting to join. Again, we're going to wait a couple more minutes. Again, thank you for everyone joining today. I'm really excited for today's conversation, as I have a small business. And also I advise a lot of clients of Black Tech Link on small business matters. So, a lot of people come and chat with me about where do I begin, you know, when starting a business. They always ask me what kind of business entity should I start with. And so I'm really excited for Patricia, who's joined us today, to kind of shed a little bit of light on different taxes required for each business entity. Go ahead and share my screen. Alrighty then. Y'all see my screen okay?
Yes.
Okay, wonderful. Let's go ahead and full screen. So again, thank you everyone for joining us today. For those who don't know me, my name is Elizabeth Cotton. I am the executive director of Black Tech Link, and I'm excited to facilitate this workshop in partnership with the Prep Institute, who is directing the Grow Up series. Basically, the Grow Up series is a program in partnership with the County of San Diego Health and Human Services Agency. Our program's accelerating business growth for BIPOC entrepreneurs and nonprofits. And if you missed us last week, it was kind of the first series in this workshop. It was getting ahead on the 2025 tax seasons. And last week we focused on nonprofits. And this week we're actually going to focus on small businesses. So I'm excited to continue that chat. Good morning, Bernice. Thank you for joining us. Wonderful, wonderful. And yeah, and please feel free to write in the chat where you're calling from. We're curious. We want to know where you're at, what kind of business you have. Please feel free to share that information in the chat. Just as this workshop is focusing on taxes, we wanted to just share that, this workshop is for educational purposes only and does not constitute tax, legal, or financial advice specifically for your business. This information provided is general in nature and may not apply to the specific circumstances of individual organizations. We recommend consulting with a qualified tax professional, such as Patricia, who's going to be giving our talk today, an accountant or legal advisor to address any specific tax or legal concerns. And then further, use your independent research to determine the use of online resources. While we strive to ensure the accuracy of information provided, our company assumes no liability for actions taken based on workshop content. And I just want to provide an overview. Basically, Project MOST, which is minority-owned support and technical assistance, empowers small minority-owned businesses and small minority-led nonprofits to grow with comprehensive training and technical assistance. The Grow Up workshops provide essential county-wide education on effective growth strategies and hands-on practical approaches. At the end of our program, after the workshop is completed, we have our talkback feature, which invites organizations attendees to join in on the call and ask questions directly to the speaker. So we're going to have that shortly after the presentation. And that way you can ask questions, share any insights, and actively engage in a meaningful peer learning environment. As I mentioned before, we're excited to be a partner in Project Most series. Black Tech Link as an organization, we facilitate workshops. So a lot of the speakers that you see are a part of our network and are very open and willing to support small businesses and nonprofits during the call and after the call. Another partner is Rise San Diego, who's been doing a great job at reaching out to make sure that minority-led nonprofits and small businesses are aware of these programs that we have going on a monthly basis. And I would like to introduce you to the director of our program, Natasha Mouchette, who's also the founder and CEO of the Prep Institute, LLC. I think you're on mute, Natasha.
Thank you so much. Good morning, everyone, and thank you so much for joining us today. As Elizabeth said, we're working with the County of San Diego, who has one particular focus, helping small businesses grow. And so we see this training on taxes as an opportunity to help you do that. So I don't want to take away from the time of Patricia's outstanding education that we're about ready to receive today. So thank you, and stay with us for a talk back so you can get some of your questions answered and address some of your concerns. Thank you again.
So at this time, I'd like to introduce Patricia Hoggart, who is a tax advisor at H&R Block. She's also my tax advisor, and I appreciate her. Patricia Hoggart is an enrolled agent who works for H&R Block in Lemon Grove, California. Patricia enjoys working with clients to get the most from their taxes and reach their tax-related financial goals. Patricia will help you with tax preparation, tax planning, bookkeeping, estate and trust taxes, and so much more. Patricia is a graduate from San Diego State University, go Aztecs, and we're excited to have her on the call today. But before we begin, I wanted to take this moment to see what type of small businesses does the audience have. You know, we want to make sure that this conversation helps all the attendees in the best way possible. So we just kind of want to learn a little bit more about the types of businesses you have. I'm going to share a link in the chat, and please, 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 please complete this quick little one question survey, just so we know what type of business entity you have, whether it's a sole proprietorship, a partnership, an LLC, a corporation. Please let us know. I'm going to stop my share really quickly. Let's see. All right. All right. And so if you need that information, it's right here. You can go to slido.com and enter in the numerical password, and it'll bring you to the question. I'm going to go ahead and let's see. Okay, I'm going to show the results. Oh, Not seeing a question. Oh. So yeah, if you go to the polls. Okay. Awesome. So yes, if you do go here, enter that. Righty then. Let me know if you have any questions. Okay. So I see S Corp, sole proprietorship, LLC, single LLC, other. Okay. Awesome. Well, we definitely have something to go off of to kind of curate this conversation today. Thank you everyone for participating in our poll. I'm gonna go back to the presentation. So Patricia, did you get all of that information?
Yes, I did. It's some of everything. I've got, yeah,
Awesome.
that's good.
Okay. Alrighty then. Okay. Patricia, I will let you take it from here.
Great. Thank you so much. All right. The first thing that, I mean, it seems that everybody has some different kind of business already. Just to do a little bit of background, whatever structure you select for your business depends on how much control you have, what the tax implications are. Liability protection is really large, like what happens if you get sued or if you can't pay your debts. The other thing is, what are the costs of operating that structure? So we have here, and then the whatever you select depends on the kind of business you own and operate and what the business purpose is and what your goals are. So the most common types are sole proprietorship, which is based on a one-person business, general partnership, which is maybe two or more people. It can also include husband and wife. A C corp, which is just a regular, AKA corporation. An S corp, which elects as a pass-through entity, which means that the corporation itself doesn't pay taxes. And then an LLC business structure, which has it's limited liability for purposes, but the taxation is just a little bit different than, say, the C corp. Now, the C corp, the S corp, and LLCs are all corporations for legal purposes. The only difference is how each entity is taxed for federal and state tax purposes. Next slide. And here's a chart that basically says, hey, how many people you're going to have on the sole proprietorship. You're going to have one person, more than two people, as we said before. In S corp, C corp, and LLCs, your business entity is separate from your business obligations are separate from your personal obligations. All right. With the sole proprietorship, and the partnership, you do not have to file any paperwork with the Secretary of State. Those are all very, very, it's easy. Those two entities are very easy to start and they're easy to terminate. You simply, if it's a sole proprietorship, you can open today, maybe get a doing business as and get started. There's nothing to file with the state or anything like that. If you're a sole proprietor though, and you have employees, then you'll have to still get an employer ID number. The partnership, again, you can have a partnership agreement. It's whatever you and your partner decide on. You can decide how much you want to split the profits of the business, whether it's 50-50, 60-40, 30-70, whatever it is that you guys agree on. And the other part of that is that percentage can change from year to year if you guys elect to do so. The C corp any number of shareholders. Now, there's some other advantages to a C Corp. A C Corp, normally larger corporations, and the C Corp has the ability to attract money. People can invest in the company. So let's say a company like Microsoft is a C Corp, amongst other things, for all intents and purposes. Then if I want to buy shares in that stock, they can, as a C Corp, they can sell shares of their company in order to raise money to continue operations. Naturally, the more money that they want, then they can issue X number of shares, and then we can buy those shares. And what the consumer gets in exchange for that is they get dividends, which means that the as a shareholder, you get to share in the profits of the C Corp. All right, now with the S Corp cannot issue stock. It's limited. It will only protect the shareholder assets. It can have no more than 100 shareholders. All right, and again, you always have limited liability. Now, what you have here is you have the S Corp and the LLC. Both of those have limited liability. The difference is how they're taxed for federal tax purposes. Those two are what's considered pass-through entities, which means that a tax form is an information form is filed. And then from those information forms, whatever your share of that business is, you're given a specific document for your share, and then that's what's reported on your tax return. Now, some of the cons is for sole proprietorship, no legal separation. If it's your business, you get sued, you can't pay debt, you're out of money. All right. With the general partnership, any liabilities are passed through directly to the partners. So your liability protection comes into play with the C Corp, the S Corp, and the LLC. There are procedures you're only limited for the shareholders of an S Corp. Then the only thing that you from an S Corp, the shareholders own the company, and the shareholders can only lose whatever they have in stock. The corporation itself is not a person. The S Corp, again, it protects shareholder assets, and your liability is limited to the amount that you invest in the company. The same thing for the LLC. Now, why does all of this matter? Okay, because nobody really wants to lose their home or cars or retirements or anything like that because the business can't succeed, or that they can't pay their bills, or if something happens, like somebody gets sued. You have to use for the sole proprietorship and the general partnership, you have to use your personal assets to pay any debts of the business. As the C Corp, only corporate assets can pay creditors. All right, the S Corp, you have higher IRS scrutiny with that, but again, as long as things are operated the way that they should, then you'll be fine. And then the LLC, your personal assets are still less at risk. Are there any questions anybody has right now? I know it's a lot of information to take in. If you have a question, you can put it in the chat. Okay, next slide, please. Now, for tax purposes, the required tax form for the sole proprietorship is the Schedule C. All right, and Schedule C is a schedule that can be added to your regular personal return, to your IRS 1040 form. And then go ahead and pull that up. Thank you. All right, so this is what the Schedule C looks like. It's basic. If you you can use your, now here with the Schedule C, you can use your own name or you can use a DBA. You're going to choose an accounting method, which everybody's going to do. And then the basic parts in doing your taxes are going to be part 1 with income, and then part 2, your expenses. All right, next slide, please. And I know that there's a lot of information here, but I'm going to, towards the later in the presentation, then I'll get to the income and expenses for each one. All right. There we go. Yeah, general partnership. You can write those, again, you can write those on on a napkin or whatever your agreement with your partner is, it's there. All righty. You're going to file that form. That your taxes, your information form is going to be Form 1065. That's an information return. So go to Form 1065. Now this Form 1065 is an information return. At the bottom of, unlike the regular C Corp return or anything else, there may be taxes at the bottom. This is just it's just a return of income. And if you scroll, you'll see that you need to say, oh, let's go here, that it'll ask how many partners, how many Schedule K1s. It'll ask about the business, name, address, federal tax ID number. It'll ask for income and expenses. Now scroll down to the section, keep going, that's information. And here there's, let's see, that's talking about partners. On here, you're going to identify the partners on the return. And then from there, go to a Schedule K1, please. From all of this information, whatever the net income is, it's going to be split between the partners based on your agreed upon percentage. There are a lot of other information questions on there, other information, whether any of those people, any of the partners are corporations or not, because corporations can actually be partners too. Now, based on the bottom line, the net income on page 1 of that 1065 form for the partnership, it's going to the information that as a partner, you will be receiving a K1, which means that it will take that information and it will place it here, go over a little bit to the right here. And part number 3, the partner's share of current year income deductions and credits. Now that information will be going to your Schedule E on your personal tax return. So if for example, if your business is a partnership and you guys netted $100,000 and your agreed upon percentage is 50-50, that means $50,000 is going to show up on line number 1 of this form for the one partner, and then 50,000 will show up on line number 1 for the other partner. So in which case the return will contain 2 K1 forms. Next slide. And again, the information from this K1 gets carried forward to your personal tax return on Schedule E.
I believe we had a question.
Okay.
It says, do you file a Schedule K1 first, then the Form 1065, or vice versa?
No, they're prepared together. You cannot prepare a K-1 unless the 1065 has already been prepared. So let's say that you are a partner in a partnership, and your partner agrees to handle all of the tax returns. So they'll take all the information to their tax professional. The tax professional will prepare a Form 1065, and then from that 1065, prepare the K-1s. And then as a partner, if you're 50-50, you should have a copy of the 1065 and a K-1 with your name on it. There's not a time when you simply prepare an individual, just one K-1 without a 1065 or a 1065 without K-1s. And that's on the general. Now, I will say that, and if I can just go ahead a little bit further, Elizabeth, that if you have an LLC and you have more than one person in that LLC, the same applies. That it is a partnership. A single member LLC will file a Schedule C as a sole proprietor. But if there's multiple people that own the LLC, then you're still going to file Form 1065 and then also issue K-1s to the LLC members.
Thank you for that.
All right, now here's the, and then I will, it's easy to go into each one, but I have to also let you know what the similarities are. Now with the LLC, I'm gonna start sole proprietorship, single member LLC, because I have to group those two together. You're gonna pay the same amount of tax for those two things. Okay. A sole proprietorship will pay tax if your net income from the business is 50,000, you're gonna pay regular tax depending on whatever your other income is on the 50,000, and you're gonna pay self-employment tax on that 50,000. The same thing for a single member LLC. You're going to pay regular tax on the 50, and you're going to pay self-employment tax on the 50 also. So the only difference between a single member LLC and a sole proprietorship is the protection from the creditors. All right. So the next thing is that with the general partnership, a general partnership, if you're a partner in a general partnership and you're a partner in a multi-member LLC, the same thing will happen. You're going to pay tax on your share of regular tax on your share of the income and self-employment tax on your share of the net income. The only difference between the general partnership and the multiple member LLC is the protection from the creditors. Are there any questions? Or what questions do you have? Just go ahead and put them in the chat. All right. Okay, so we've covered partnerships and we've covered sole proprietorships. Okay, let's move on to S corps. All right, now S corp's a little bit different. It has stricter rules from the Internal Revenue Service. S corps do not pay corporate taxes. Just like the LLC, the net income flows through, aka pass through, that it's taxed on the member or partner's return. The difference is that you only pay tax on the net income. You don't pay any self-employment tax. Which you're like, okay, so $50,000. All right, if you got $50,000 net income, then you could literally save 15% of that in taxes because you're not paying self-employment taxes on that. You get limited, you don't have any personal liability. You can have 100 owners, no more than that, but only one class of stock, which means that you can't sell any stock to anybody. Now, that sounds great, right? No self-employment tax. If it's $100,000, I'm gonna save, $15,000. Easy, right? There is a rule for the S Corp is that you can pay for the S Corp, you can pay yourself a salary. You cannot pay yourself a salary on a sole proprietorship and on a LLC where you're taxed as anything other than a corp. And it has to be reasonable. And the IRS made that rule because they don't want for people to say, hey, I netted $100,000, but I don't want to pay any self-employment tax. So there has to be reasonable compensation for the shareholders. All right, go ahead and put that form up there. It should be an 1120S. And you'll note that the 1120S looks similar to the 1065. You still have to give them the same amount of information. And most of the expenses are generally the same. You're still going to have to identify the partners, or AKA members. And then there will be a form 1120S, a Schedule K1 for the member's share of income and expenses. Now, for this 1120S, there's some additional information you're going to need. It will probably ask about bank accounts, about liabilities, about accounts receivable, which means that you may have to do a balance sheet for it. Okay, next slide. You can show the K1 for the 1120S. It looks pretty much the same as the K1 for the 1065. If you go to line number 1, it still says ordinary business income loss. The lines are pretty much the same. Okay, next slide. Okay, we covered those. Okay, let's go to C Corp. All right, a C Corp is the most complex of the entities. It is a separate legal entity. It has limited liability. Owners are not personally responsible for the corporation's assets. Now, the double taxation that you're going to hear about, the double taxation means that the corporation actually is an entity that pays taxes. And then the shareholders own the stock, and they have a board of directors, and they manage the corp. Now, if we go to the form, okay, the form that's filed for a C Corp is going to be the 1120. And that form actually that form is functionally the same as the 1040, where the bottom line is you figure the taxes on the entity. If you scroll, let's see, down. Okay, scroll down. And hold on, before you go there, hold on, down. All right. Look at line number 30. It says taxable income. All right. And then line 31 says tax on Schedule J, Part 1. That means that form, that there are corporate tax rates. And some of them are more than the individual tax rates. All right, so this is actually a tax form rather than an information form. All right, you'll see taxable income, total tax, minus payments and credits. Okay, if you have an estimated tax liability, and then just like on your regular form 1040, there's an amount owed and an overpayment on lines 35 and 36. There is no K1. There is no K1 for a form 1120. Okay, next slide, please. Okay, now that we've done that, what I want to bring to your attention is, now we've talked about the LLC, the multiple member LLC, and we've talked about the S Corp. I'm going to try to say this slowly, so if for any reason you have a question, please put it in the chat. A multiple member, okay, an LLC, regardless of whether there's a single member or multiple member, can elect to be taxed as a C Corp. They can be, okay, let me back up. It's a little complex. An S Corp can elect to be taxed as a C Corp. A multiple member LLC and a regular LLC can elect to be taxed as an S Corp. So you can make those elections. So right now, if you're just a single member LLC, then you can, and because you don't want to pay that self-employment tax on your net income, then you can elect to be an S Corp. All right, and the question is, how do I do that? There is a form, it's called a form 2553. Now, normally this form is due by March the 15th after the end of each year if you're a calendar year taxpayer. But if you don't do it then you can also do a late election with your tax return. If you make the election before you do a tax return, when you first start, before you do a return, then you can submit that form separately, just all by itself, to the Internal Revenue Service. Otherwise, it's going to go with your tax return. What you'll recall that, okay, once you decide that you want to be taxed as an S Corp, then you have to make sure that the members have reasonable salaries, because you can deduct the salaries. Are there any questions? All righty. Now, common deductions for business. I'm going to say business owners, because all of these items listed here are on each one of those forms. It doesn't really matter which form you fill out, whether it's a Schedule C or a 1065 for partnership, or an 1120S for S Corp, or for a C Corp. All of these things are, the only thing that is not available for a C Corp is the qualified business income. So as Elizabeth was pulling up the different tax forms, there were some things that you need to know. Here, the startup cost. I will start first by saying the startup costs. Now, startup costs are those costs that are crucial to getting the business started. And you cannot, so let's say if you spend $50,000 in startup costs, you cannot deduct all of those startup costs the first year you do business. There's a limitation of $10,000 to $15,000 that you can write off during that year. Anything more than that amount, then you have to amortize over 15 years. Business expenses. Now, what I want to cover with you on business expenses is that the Internal Revenue Service is a little bit crazy about what is a valid business expense. You have to remember that ordinary and necessary are the key words. Is it necessary for your business? And is it one of those is it something that people normally do or normally spend money on as an expense for the type of business that you're in? Those businesses include rent, utilities, supplies, equipment. You know, you may even have some salaries, but that's going to be later on. And when it comes to the rent, so let's say that you're an individual and you have a sole proprietorship or even an LLC. If you rent business space for a space for your business where you conduct business, all right, then you can deduct that. If the space that you're paying the rent on is your personal residence, which means either you're owning the place or you are renting a house or something, then we're going to cover that in your home office expenses later, because there are some considerations that we need to take into account there. And you're going to need specific information for your tax return for that. All right, the same thing with utilities and supplies and equipment are going to be those things that are absolutely necessary for your business. Employee wages and benefits. Regardless of your entity type, you can hire employees and you can pay for insurance and you can provide bonuses and health and any kind of health benefits. In order to do that, you have to do two things. One, register with the federal government and have a tax and employer ID number. And the second thing is that you have to register with the California Employment Development Department in order to report payroll taxes. There are quarterly payroll tax forms that have to be submitted for employee wages and wages. And then also when you have employees, there are federal forms. There may be federal tax deposits that you have to make, and also federal quarterly payroll tax returns. Interest on business loans. Now, while you may get a loan for a personal loan for your personal expenses, those are not, you can't write those off. But if you get a business loan, you can write those off. Specifically, if you're financing your business for that, and that is a deduction on the return. Let's go next with depreciation. Now, depreciation has to do with the writing off the use of your equipment, right? And then you have a couple of choices. Let's say that, let's say that you're in a consulting business and you spend $10,000 on a computer. Well, that computer is equipment that you're using in your business, and you need it to keep track of books and records. You need it to keep track of, to do contracts. You need it to do invoicing and do all your accounting work. Well, there's a couple of ways that you can handle that. Now, one is called a Section 179. You have options when it comes to equipment that's used in your business. You can spread out the amount that you paid, that $10,000, you can spread it out over, say, 5 years, which almost $2,000 a year. And that means that you're only going to get $2,000. You're only going to reduce your income by $2,000 per year. Now, if you take a what's called a Section 179, then you can pretty much write off the entire $10,000. All right. And then there's also, if you spend more than that, then there's also some bonus depreciation. What I will tell you as far as tax planning is concerned is that reducing your income by $10,000 in a given year, and that $10,000, again, it's just an example for the equipment. It depends on what your total income is. So if the first year your income is 15 and then you write off this 10,000 for discussion purposes, you have $5,000 net income, which is good, right? Because $5,000, easy to pay tax on $5,000. The downside is that, let's say that your business is going to triple next year. Unless you make that same expenditure for something else in the next year, you don't have anything to write off with regard to that equipment for the next year. And ultimately, you may end up paying more taxes as a result of that. So when you're considering equipment purchases and how you're going to handle that for tax purposes, then the consideration is going to be, how much did I spend? What is it going to cost? And not only what's it going to cost this year, but also for upcoming years. You will choose, okay, well, am I going to pay less taxes today and more taxes next year or in future years? So that's a tax planning issue that needs to be looked at with you and your tax professional when it comes to equipment. Bad debts. Let's say that so now that's going to depend on whether you're on a cash basis or an accrual basis. All right, accrual basis, and I will give you the very, very simple definition that my accounting professor gave me. He said, if you're on an accrual basis, okay, you have an asset and you have a liability. You debit CAL and you credit accounts payable, which means that you haven't given any cash to the person that you got the CAL for. Okay, if you on the cash basis, you debit CAL, which means you got a CAL, and you credit cash, which means that you're out the cash for it, which means that now you're literally paying cash. It has more to do with timing of when you pay for whatever it is that you got. If you're on an accrual basis, which means that I'm selling this now, I sold you something today for $1,000. Now you owe me $1,000. If you, and I include, and on an accrual basis, I include that $1,000 in my income. If you don't ever pay me, I can write off that $1,000 as a bad debt. If I'm on a cash basis and I sold you something for $1,000, if you never pay me for it, because I'm on a cash basis, I'm not recording any income because I haven't gotten any cash yet. So there is no bad debt when it comes to you being on a cash basis. If you're on a cash basis and you don't collect, there's no write-off because you haven't reported any income. Because on a cash basis, you're only reporting income when you actually receive the cash. You're only recording the expense when you pay for it. Does anyone have any questions regarding bad debts?
I see a couple of questions in the chat.
Okay.
Let's see. I still want to share release. Amanda, yes, we'll provide a copy of the presentation. Is there an income limit that determines if an LLC can file as an S corp? What is the
No.
criteria?
Okay, so if an LLC wants to be an S corp, you simply have to, before making the decision, you have to actually do the calculations. So what I will generally tell you, if you were sitting in front of me saying, hey, I'm an LLC, here's my income, and here's my income, and here's what I'm doing right now. Then what I'm going to do is I'm going to say, as an LLC, here's how much taxes you're paying on the income for you being an LLC. And then I'll say, okay, now based on that, then we have to again figure whether you're okay. So I'm going to give you an example. I'm going to try to give you something that's going to be easy. So let's say $100,000 is your net as an LLC. You're going to pay, and I'm going to say 20%. So let's say you're in a 20% tax bracket. So your tax liability is going to be $20,000. And then you're going to pay another, say $15,000 for self-employment. So that's $35,000 in federal taxes that you're going to pay for being the LLC. Now, if you were to convert to an S corp, that $100,000 is going to be something different because you're going to pay yourself a salary. So let's say that you pay yourself a salary of $40,000. All right. So what happens is that your LLC income now becomes $60,000 because you're writing off that salary, and that $40,000 salary you're taking is going to be on a W-2, which that's where you're going to say, okay, here's federal taxes withheld, here's Social Security, here's any retirement, any of those other things that are there. Now on the $60,000, so on your rate now, the $60,000 goes, so you're going to have a W-2 that's going to go on line 7 or 8 on your personal return. You're going to have $60,000 that's going to go on your Schedule E for your S corp, for your S corp. Now, if you're at the 20, you're going to still pay this. You're still ultimately going to pay the 20%. That's not going to go away. You're going to save that $15,000 in self-employment tax. Now that comes with a caveat. Most of the people that convert from LLC to S corp say, hey, I don't want to pay taxes. I want to save more of my money to put into a retirement account. So if you take that money, if you convert to the S corp and you save some of that money and you literally put it into a retirement account, where it's going to grow for you so that once you're old enough to retire, you have substantial income from it, then that's a great move. If you don't set aside money for your retirement, once you become an S corp, then the only money that you're going into retirement with is going to be the $40,000 in Social Security that's being racked up, that's being sent. Now, with the LLC, since you're paying that $35,000, that $15,000 that you're paying in for that's going to the Social Security Administration. So that once you're old enough to collect Social Security, you'll get that money back. The difference is that with the LLC, the $15,000, you're going to get that money back later on through Social Security. And that's based on your $100,000 in income. With the S corp, the only thing going to Social Security is the $40,000. So your Social Security payments will be based on the $40,000. So if you're going to be very diligent and very aggressive about saving via 401k or some kind of retirement plans, once you're an S corp, then that will increase what you will have later on for your retirement. So the short answer, no, there's no dollar amount. You simply have to make sure that the corporation, you're going to have the employer share of any wages or salaries. So you have to do that. You might have some additional federal employer taxes that you have to pay. But the biggest win for most people is going to be there's no self-employment tax. So the good news is there's no self-employment tax. The bad news is there's no self-employment tax. It really is going to depend on how you envision retirement down the road is going to look like. Does that answer your question? Or is there any other part that I need to explain a little bit better?
Yeah, there's so the 15,000 would need to go into a retirement for an additional discount with the S corp.
Well, no, what happens is that with the S corp, you don't pay the 15,000 because you no longer pay self-employment taxes. The benefit of being an S corp is that there are no self-employment taxes. You only pay regular tax on whatever the bottom line income is. But while you're paying that less tax, you remember that without a retirement account or an IRA or something that's going to help you during your retirement years, then Social Security is going to be a whole lot lower. Okay, let's get back to our slide. All right, now, travel expenses. Yes, you can deduct travel expenses if you have to be away from home longer than your ordinary day's work and you need to rest. It includes Uber, trains, planes, automobiles, all of that. The difference is that, oh, here we go. Dry cleaning while you're away from business, baggage and shipping, phone, and also tips if you're traveling. Now, the only restriction is that meals are going to be limited to 50%. Whatever you buy for meals is 50%. Education expenses. This is going to be continuing education for your profession. All right, now on the expenses, that depending on what it is, then if it's college or anything like that, then you may be entitled to some education credits rather than deduction for the expenses. But the one that you choose will depend on which is going to give you the greater benefit. I also want to add car and truck expenses. Now, with regard to car and truck expenses, the standard mileage rate is 67 cents a mile for 2024. There's two ways you can calculate your deduction for any of these expenses. Either standard mileage rate based on the 67 cents a mile or actual expenses. You can use whichever is greater, whichever gives you the best tax benefit, you can use. The caveat is that if you use actual expenses, so let's say you buy a brand new car in 2024, and you want to get that big depreciation deduction for it, and it's going to lower your income. Once you use actual expense, you have to always use actual expense. You cannot flip-flop back and forth between actual and standard. A couple of things are going to be needed for the actual expenses. So let's say you have one car, you use it for business and use it for personal. We have to know how many commute miles, how many other miles, and how many business miles, because with actual expenses, you have to keep track of every time you buy gas, every time you get an oil change, every time you service the car, every time you get it washed. And then you get to write off whatever the business percentage is. So if all of that, if all of your vehicle expenses, the actual expenses were $7,000, then you only get the business percentage. If the business percentage is 50, you get half of 50. You end up comparing that to, okay, the whatever number of business miles times 67%. If that's more, then you take more. Regardless of the mileage method that you use, you're required to keep a mileage log and document the trips that you make. Okay, retirement plan contributions. You have several options for those. There are IRAs, there are SEPs, there are Roths, there's Simples. All of those are retirement contributions, especially, if you're just a regular partnership or just a general partnership or a sole proprietorship, then you may, if you're not doing the business full time, you may be employed by an employer. If that employer has a retirement plan, then the amount that you can put in an additional IRA may be limited. If you're in the business full time, then you may be able to deduct up to $7,000 a year for an IRA, unless you're over 50. So any of those retirement contributions they're going to be flexible. Normally, if you have any IRAs or a SEP, then the deadline, you can take those deductions on your tax return as long as the money is in that account by the due date of the return. If you pay your own health insurance premiums, then you can deduct that. If you pay for health insurance premiums for any employees that you have, you can deduct that. Home office expenses. Now that's a big one because I see I get people that come in and they say, hey, I want to deduct my home office. All right. The rules for the home office: the business part of your home that's used exclusively and regularly for business. Exclusive is only for business, which means that you can't use that area for business and for personal. Regularly means continuing rather than occasional or incidental for business. It's the primary purpose for the space. It has to be your primary place of business or a place where you meet clients or a separate structure not attached to your house. In order to get ready for 2025 for this piece of information, what we're going to need is we're going to need to know, okay, what is the mortgage? If you own the house, what is the mortgage? What are the property taxes? What is the insurance? What's the square foot of the space that you're using regularly and exclusively for business versus the total space for the entire facility, the entire home? If you're renting, we're still going to need how much is paid monthly for rent? How much are the utilities? Also, you get to include if there are any repairs, you get to include all that. So if it's a 1,000 square foot home and 10% of that space is used for regularly and exclusively for business, then you're looking at 10% of the total cost for that. A couple of things with business use of home. If your business is not profitable, you cannot use this to create a loss for your business. It's not allowed. All right. So it's a percentage. Now there's a simple calculation that can be made, but it only gives you something like up to maybe $1,500 that you can write off of your business expenses. So that's a matter of how much. Oh, okay. I got it. All right. So let's say that you have business use of home and you get through your schedule, let's say your schedule C, and you have $300 left over before your business use of home. Then you cannot deduct $1,500 worth of business use of home to create a loss to offset your other income. Because the 300 minus 15, that gives you a negative $1,200. That's a $1,200 loss on your business, and you cannot use a business use of home for that. You cannot have a loss using the business use of home. You can't generate a loss by taking advantage of that. Did that clear that up for you? Okay. Now, I know that I'm looking at the time here. This is a ton of information. Qualified business income. Okay, raise your hand if you want to save 20% of your net profit from your business. How many hands went up? I can't see. All right, so the qualified business income is available to all entities except C Corps. And what happens is that you take the bottom line, which is your share of income from a partnership or LLC or S Corp, and then you get to deduct on your personal tax return 20% of that number. Elizabeth, do me a favor, pull up the Form 10. I want to pull up the Form 1040, and it's page 1, please. Go to page 1 and no, I need the 1040. All right, okay, so let's go, hold on. Let me go here, down here. Okay, oh, stop right there, line number 13. There's a Form 8995 that calculates 20% of your income. And that 20% of your income goes on that line right there on your personal return. And it's got some home. The other top part of this form just tells what kind of business you're in. And then it lets you know what the income, the loss or income is. Then once you get to line number, let's see, line number 4, that tells you the total qualified business income. Line number 5 is multiply that by 20%. Once you get all the way down to the bottom here, total, and I want to say line 15, then that's the amount that's going to go forward to your Form 1040. So ultimately, that's going to reduce your tax burden for the regular tax by 20% of your business income. It does not reduce the self-employment tax. For any of you guys that are LLCs or sole proprietorships, the only way self-employment tax goes away is if you have refundable credits or you actually pay the money in with estimated taxes. Or that if you have another job, then you have a ton of withholding, so much so it's enough to cover your tax liability. Again, those things are things that you need to review with your tax professional so that you can do tax planning from year to year. I want to mention some other deductions you're entitled to take. So the person that was there asked about what if it's a loss? What if your business loses money for the year? Guess what? You can carry those losses for as long as you're filing a business return. You can carry those losses forward for an unlimited number of years. You lost $5,000 last year. This year you maybe made $5,000. You can use that loss from last year to offset your business income this year, so that you ultimately don't have to pay some taxes. So any losses do not go away. I want to spend a couple of minutes talking about tax credits. Again, and because part of this is tied into your personal return. With the business, you can get a clean vehicle purchase credit. The new vehicles are up, the credits are, if you purchase one, is up to $7,500. You can get a small employer pension plan credit for setting up, and that credit is up to $5,000 for setting up a SEP or IRA or qualified plan for your employees. If you own a business and you purchase a solar system to go on the business, guess what? You can get a solar credit for that. If you're doing business, but you're not making a ton of money, depending on your filing status and size of family, if you have kids, then you may be entitled to some earned income credits. If you're setting aside money for retirement, there's savers credits. If you're taking classes, there are education credits. And then one other credit I want to mention that very few people are aware of, if normally people may be over reporting and getting refunds for their federal returns, but maybe not on the state. If you give money to, it's called a college access tax credit. It's only for California, where you give money to the state of California specifically for scholarships for college students. The credit is 50% of your deduction. So if you give $3,000 to them, your tax credit will be a $1,500 credit against your California taxes. If you also itemize deductions on your federal side, you can still take that $5,000 as a charitable contribution. So I just thought I'd give you that piece. All right, go ahead. Next slide, Elizabeth. All right, payroll taxes. This is information for that again. You need to do quarterly tax returns. We mentioned that before. We've talked about employees and state and federal employment taxes. I'm going to scroll down to number 7, 10 miscellaneous. Okay, that's a subcontractor. If you do not control the work, if you just says, hey, I just want this done, you don't control anything else, they provide their own supplies, then yes, you've got a 1099 miscellaneous or 1099 NEC, which is non-employee income, a non-employee compensation. Those forms are due by January 31st each year. If you control the work, you tell them the who, when, what, why, where, then they're more than likely employees and you need to be doing the payroll taxes for them. You need to maintain records, and then the state and federal government are really, really bad on failure to comply with these, with the payroll tax deductions. If you issue a 1099 to somebody and you don't send the appropriate forms in to the government, then they will penalize you for that. Or if you do it late, the same thing for W-2s. You want to make sure that before you do any of these stuff, consult a tax professional so that they can give you guidance as to when and how to make sure these things are done. Last but not least, tips for success with your taxes. Maintain adequate books and records. Yes, you can obtain a camper. Use it. Yes. Okay, so obtain a camper, use it full time. Yes, you can, but it's still determined based on the square footage that's being used for business. All right. Books and records are important. If you come to me at the beginning of the year, anytime during the year, and you say, hey, I want my taxes done and I have a business, there's a couple of things I'm going to want. I'm going to say, well, where's your income and expense statement? And you'll say, well, I have this, I have these slips of paper. Nope, doesn't work. All of that needs to be summarized in an orderly form because that's the way that it goes into the returns. All right. File returns and extensions on time. Respond to IRS notices, both the IRS and California. Sometimes it's an email. Sometimes you can get them on the phone. Get professional help or either help with from the Internal Revenue Service. There's a bunch of help that's out there. No, I've got here income and expense statements, balance sheets, no shoe boxes with the receipts in them. Categorize, depending on your business, categorize your income and expenses based on your tax form. Okay, Elizabeth, I think that is it. Any additional questions can be put in the chat.
No, this was such good information. Like, I really appreciate you.
It is. I mean, it's a ton of information, and there are other things that are more detailed, but it would take a lot longer than the time that we have to go into any more depth than what we have.
No, I completely understand. And, again, thank you for your expertise and sharing insight. I know this was very helpful for a lot of people on the call right now. And for the attendees, please let us know how we did on this workshop. This has been like one of the first workshops where we focused on small business taxes. And so we want to get your feedback. I did put a link in the chat for survey. Please let us know how you did. Let us know how we did, as we want to continue this program in partnership with the county. We definitely need to know, like, knowledge learned, any resources that that you obtained. We want to hear from you. So please, please, please go ahead and take our survey. I'm going to go ahead and put it in the chat again. And at this time, I really, we have a few more minutes with Patricia. I wanted to take this time to bring the attendees into the call to ask her any questions directly, any comments, any insight that you may have regarding small business taxes that you want to briefly touch on. This is now the time to do that. And so I'm going to go ahead. Awesome. So I've invited you all back for our talk back session. I saw Andrea had a question. Are startup costs able to be deducted after the first year of your business? I had a lot of startup costs during the first year, but didn't take the full deduction because I didn't make a profit the first year.
Okay, so what you may ultimately end up doing is you got a couple of things. If you didn't take them all, if you one, startup costs are generally what they call capitalized, which means spread over a certain period of time, right? So if you didn't take them all, depending on how much it is, then you may be able to go back and amend the return, the prior year return, or you simply just capitalize you just use whatever the rest of them are, and then go ahead and now, are you saying you had more startup costs after you started? Let me make sure I'm
Yeah,
getting that.
yeah. So I've only been in business for about a year. So I
Oh,
just started my business last year, and I spent a lot on startup costs. I started my business in December of 2023. So I had a lot of startup costs in 2023. So when I filed my taxes, I didn't end up really using them as a deduction because I didn't really need to. So now I'm wondering for this next tax return if I can put any of that on the next tax return or if it's only during the first year.
okay, so I want to first, before I get to that, I'm going to ask what kind of costs are we talking about?
A lot of it was like tuition for classes, but then also for equipment.
Okay, so here's the thing okay, so in writing it off, so then you're going to look at and that was in 2023, and then all those costs were incurred you paid for those things in 2023.
Yes.
Okay, so you can amend 2023 to take advantage of any education credits that you may have been entitled to. All right, and then as far as the equipment, if you bought equipment in 2023 and you didn't, okay, essentially you did not say claim all of it, then you don't have to remember what I said about equipment is that you said if you claim it all the first year that you do it, then you can't you can't use it for any other years. So anything that you bought in 2023, you already wrote off some portion of it. The rest of it you can literally write off for for 2024 in the coming years, especially if it's the same assets. Or did you just say, okay, I bought this, this, and this, and I'm going to use this, and then this, and this, and I'm not going to write it off?
So I guess I'm just wondering, so like when I file taxes for 2024, would I be writing them in the startup costs again?
No, if it's equipment, it's not necessarily a start. I mean, you've already started your business and you start your business in 2023. When I say startup costs, those are generally those things that you incur prior to opening your business. It's like, okay, look, setting up your corporation, opening bank accounts, doing market research. That's what's classified as startup costs. Your equipment and tuition is not necessarily a startup cost. Those are just regular expenses.
Okay, that's helpful. Thank you.
So if you said, hey, I bought, 4 pieces of equipment, I only wrote off 3 of them, then the downside is that if you say that so let's say that you bought something for 10,000 and you put it in the service in 2023, Well, if you add it to your 2024 return, then some of the depreciation for that you're not going to get because it's in 2023. So you have to take a look at it. Whoever did your return for 2023 can go back and do a calculation and say, okay, are you really going to save any money by making those changes?
Okay, that's helpful. Thank you.
Okay. All right, next question.
Did anyone else have any questions or comments? Anything they wanted to share?
I'd like to share thank you to Patricia. This was outstanding information. I know
Oh,
it's
girl,
a
I
lot.
had lots more. I'm telling you, I had to
I
like,
know it's a lot to cover.
I was like, oh,
We all need to go to the University of IRS taxes somehow. But I want to thank you for bringing your expertise to the table and teaching in the way that you did. I also want to share with Andrea and Bernice that Patricia is available. I think her contact information is on the last slide, and you'll be receiving the presentation. So please, Andrea, if you have further questions about your taxes, take advantage of the opportunity to reach out to Patricia.
Well, I want to thank you both and thank you, Bernice and Andrea for joining our call today. This about wraps it up, and I encourage you to please reach out to Patricia. Patricia, when do you begin tax season again?
the middle of December.
Well, thank
So
you
yes,
so
but
much. I did. I'm sorry. I'm
No, go
sorry,
ahead.
Elizabeth. I do want to say thank you so much. I will be reaching out. This was really great. I love your patience. I love your detail. And God knows I need some help.
Well,
So
you know what?
thank you.
I will tell everybody online, okay, there's no need to be afraid of the Internal Revenue Service. Sometimes they just ask questions, and there's pretty much not too many questions that they can ask that don't have an answer. And the biggest thing is, okay, if you're nervous, don't put it off. Just sometimes I'll just tell people, look, pick up the phone, tell them you don't have it right now. I will have it in a month. I will have it in 6 weeks. And deal it that way. That way you can breathe. I did print out one more thing, but I thought it might have been too much. If for any reason you get in too deep and you owe the Internal Revenue Service a bunch of money, that there are settlement options that are available that you can take advantage of.
Mhm.
That you fill out the forms, answer the questions, and then they will say yes or no. You can also do that with the state of California. But the biggest thing is that here, be proactive, respond to notices, and don't be scared to ask for help.
Mhm. Awesome. Wonderful. Well, I will be sharing this presentation with our network, Project Most participants as well. So you'll be able to get the presentation as well as the recording. And I'll also share Patricia's contact information. Perhaps you guys, if you're very interested, you can reach out to Patricia before her tax season and she can kind of walk you things to prepare for when she does get back in the office in December. But I want to thank you both, Patricia and Natosh, for joining us today. And I guess that concludes our call. And I look forward to the next Project Most workshop.
Thank you, Elizabeth.
All right, thank you.
Facilitating it. Appreciate it.
All righty.
So Elizabeth and Patricia, can we stay on for just a minute?
Sure.
Thanks. Thank you, Andrea and Bernice.